Few moments you will see just a few excerpts from the numerous television appearances of Peter Grandich. Mr. Grandich is the editor of 4 widely read investment newsletters. The Grandich letter, which began in 1984, includes all of Mr. Grandich's forecasts and recommendations. North of the Border reviews all investment opportunities and economic changes in Canada. The Blue Chip and Income Report covers opportunities in the income-oriented arena, as well as high-quality blue chip stocks. The 4th letter produced by Mr. Grandich is the High Flyer Report. It is dedicated to identifying speculative investments with above-average potential. Mr. Grandich's recommendations have turned in amazing 54% annually every year since 1984. He has demonstrated the ability to recognize significant market moves up or down in the stock, bond, and precious metals market. Since he entered Wall Street in 1984, Mr. Grandich has been able to forecast any move of 10% or more in these markets beforehand. Mr. Grandich has become one of the top authorities on the investment scene today. Several financial commentators and Wall Street peers have paid high compliments to Peter's complete willingness to give clear, unhedged forecasts without double talk in a manner that even the novice investor can understand and appreciate.
Just about a year, as a matter of fact, a year to the day since the great stock market crash. You remember that, right? Market plunges 500 points on 1 zillion shares. Visions, man, of bread lines, people jumping out windows. We're everywhere. Wait now. Everything seems okay. Was this a bad dream, or was it a crisis just for the fat cats on Wall Street? Or was it the media again, scaring the living hell out of everyone to sell newspapers? Tonight, we'll take a look back at the great crash and talk to the so-called experts. You don't remember of them any opening their mouths before the crash, do you, huh? How many people did they get out before it happened? Join me. We'll find out. Did you get your guys out?
You've heard the typical Wall Street explanation now about the crash. Now I'll give you the real scenario of what occurred. First of all, Wall Street puts too many people in the market that just shouldn't be. We had a bubble burst, and unfortunately, the most people who suffered that bubble burst were the people who could ill afford to afford it in the first place. And unfortunately, I may not have as many years in the business as this gentleman, my 4 years or so. Many of us were just simply inexperienced. I will condone him on the fact that many didn't experience a crash, wouldn't know what it was like. Unfortunately, Wall Street doesn't worry about that too much. They're just concerned as long as you're producing, as long as you're bringing money in, because it's a sales organization, just like any other place.
I mean, you guys, realistically, a lot of the guys down there are no damn different than magazine salesmen. I mean, you're soliciting from lists that you bought. I get 5 calls a day from every damn vice president that works for Merrill Lynch or whoever the hell it is. Snyder on that they sell to. Peter, you've made your way to Wall Street, I think, in a very unusual fashion. You made a lot of money in the market, and your newsletter is one of the more respected ones. Now, what's your opinion of the average stockbroker these days?
I would say that the minority in the business are worth their weight in gold. I used to head up investment strategy for a firm where I got to know maybe 50 brokers firsthand, day in and day out. If I wasn't in the business, maybe 5 or 10 I would have given my money to. The rest I wouldn't. And that's the extent of it. You have to recognize that in investments, there's only 2 types of advisors. Those who say what they think, as I believe both of us are, and those who say what they think you want to hear. And that's the only difference.
Look at where we should have put most of our money in late 1987. Money manager Peter Grandich, often called a Wall Street whiz kid, has been making 50% a year for his clients in recent years. He called the crash of '87 just in time. Not bad for a high school dropout. He says now is a good time to lock in high savings rates.
Yes, it is. I believe financial assets, particularly the bonds and CDs, are going to be a great time. We're going to see significant lower interest rates in the next 12 to 18 months.
You are? Okay. So how would you go out and lock them in right now? Just a 5-year CD at a bank, or buy bonds, or what?
Well, depending on your tax consequences, some people need tax-free investments. I would think optimally right now, 3 to 5 year CDs and about 5 to 7 year bonds would be the answer.
Leading personalities. Now the host of Ask Washington, Larry Butler.
Hi, everybody. Investors have been playing a cautious waiting game in both stocks and bonds. Wall Street has been in a correction, with the Dow Industrials down nearly 4% since the first of the year. Well, bonds have been depressed because of sharply rising long and short-term interest rates. However, the bottom line shows no major sell-off. Well, is this a good time to get into the stock market? What about bonds? How will the Drexel-Burnham collapse and the S&L crisis affect the markets? Answers coming up from our guest, Peter Grandich, Chief Market Strategist for Affiliated Financial Management. He produces 4 newsletters, and last year, 83% of his recommendations were profitable for a 54% average gain. That's pretty good. We welcome your investment questions for Peter Grandich this morning. Call us on our toll-free 800 numbers. You'll see those numbers coming up on your television screen, and the numbers again are 1-800-368-5781 and 5782. And in the Washington, D.C. area where this program originates, the number is 463-3170 and 3171. Peter, it's a pleasure to have you with us.
Thank you for having me, Larry.
Look, stock market investors have been pretty much staying in the sidelines. Last week we had a whole slew of pretty good economic numbers, from housing starts, and the trade numbers were much better. We had the record housing start figure. We had industrial production that was strong. Retail sales looked good. But that didn't seem to impact investors' attitudes, because the market closed down about 12 points for the week, closed down on Friday again, and it appears they're just sitting and waiting. What are they waiting for?
Well, I think those numbers were an aberration. The trends still in many of those areas, the trade deficits, interest rates, what have you, are still quite bearish, and I think the market is being quite cautious, and probably for the first time in 8 years expressing some concerns that we may be indeed in a bear market in the beginning stages.
Now, if you're looking for solace, don't look here. Our next guest is a real bear. Peter Grandich is the Chief Market Strategist of Affiliated Financial Management. We're glad to have you with us, Peter.
Thank you for having me.
A lot of people looked at the way the market finished up today, and people we talked to through the afternoon said this is essentially good news, considering the pounding the market might have taken over the CPI and the events in Japan earlier today. To have only wound up with a 13-point loss sounds like a resilient market.
Sounds like a bear market to me, and the reason it does is we're now quite happy that it wasn't all that bad. We're just kind of happy that we just escaped with a not too bad of a loss, and that's usually the signs at the beginning of a bear market. And if you think about it, if you went back and looked at what most people were saying just at the beginning of January, we shouldn't even be at this point based on that time. So I take solace in the fact that it was only a little bad, because we're so used now for 8 years of getting quick wipeouts. A crack and a crash have been the only down moves we've had in the market, and for the first time I think we're going to have an orderly retreat, and this is historically what happens during an orderly retreat.
Or you say an orderly retreat, so a slow bleeding from here, and to what point?
Yeah, instead of the hands right around your neck, they just got their couple fingers at this point and takes the air out a little at a time. And I think, as I said, I don't try to get on a day-to-day basis, Neil, as you know. I concentrate on 6 to 12 months, and as I said, I still that the market will be at 2,000 in the next 12 months, and
That's still a rather precipitous decline. You're talking better than 500-point tumult, so that's what it would amount to.
Well, I think we'll average, as we go to quarterly, we'll drop about 5%. We'll have intermittent rallies, but we'll eventually get down to that level. And what's really important here, if we look past the Dow, we start looking at the S&P 500 and start getting to the value line index, they clearly have not had the gains that the Dow has had and are really in long-term bear markets. And also there are a couple of groups that have had bear markets during a bull market, and they're kind of rebounding. You're seeing some of the technology stocks we spoke about last time are acting well while others aren't. So all in all, I think we're heading lower.
Peter, why a long-term bear market? Why not a short-term bear market?
Well, I think it's different this time. I think what's happening is there's caution now by money managers. In this business, you got to try to stay alive, and what's happening is they're going to take the easier route, and that will be bonds. It'll be far easier to satisfy people with 9%. Now, I think 9%, if we get up there, as I've said in the last few days, is going to be a gift from God in terms of a return compared to the stock market. And I think money managers are going to be more heavily weighted in bonds than any time they've been in quite some time. And with that, we'll see a market rally probably back down to 7% in the next 12 months.
Well, Peter, could I advance an argument that is people who are a little less pessimistic than you are? They take a look at what happened in Tokyo overnight, the fact that the market didn't collapse, the fact that we have a situation in some markets where rates are actually higher, interest rates are higher, in Germany most notably, but we haven't seen a retrenchment on the part of foreign investors out of this country. The credit markets have held up despite some rather market jitters, and all is not as bad as Peter Grandich says.
Well, again, it's always whether the cup is half full or half empty. Case in point, I don't think we're ever going to see that where Japanese people are going to pull out their money. And there's a simple reason. It's been politically favorable for them to support our budget deficit. Since we want to spend more than we take in, they saw that and took advantage of it. Now, we don't see it day to day, but behind the scenes, that's a very strong political wedge when it comes in terms of trade and what have you. And I don't believe the biggest fear I would have of a pullout would not be from the Japanese. I'd be more concerned from Western Europe, because people forget that Great Britain still owns the most assets here in the U.S. We hit Japan over the time we complain, but Great Britain sits back and they're quite satisfied. It's just going to be an orderly retreat. We haven't had a bear market in 8 years. People forgot what it's about. A lot of us haven't even experienced it.
Peter, why wouldn't American investors, money managers who you say would be tempted by 9% should our bond get up that high, why wouldn't they just go to West Germany and get 9% right now?
Well, they can go to Britain and get 15%. They're not accustomed to it. And there's other politically and somewhat favorable reasons to stay within the U.S. as well. And of course, the investors are used to investing here in the U.S. They're not. It's only in the last couple of years this intrigue about investing overseas has come on. So Wall Street has a tendency to say what people want to hear versus what they think is best. At least it appears that way sometimes. And right now, investors are only getting accustomed to investing overseas. So I think they're much more comfortable here in the States.
But in the meantime, Peter, our Dow has already come up 200 points and then some from its high. A lot of people would say your correction. There you have it. It's done. Call it a day.
Well, all I can tell you is I like to be a live chicken versus a dead duck, and I like to be proven wrong, and then we'll react at that point in time.
You certainly are the person who's most sanguine about it being a bear market anyway.
There's nothing wrong with it.
Nothing wrong with it.
Nothing wrong with a bear
All
market
right,
every
well,
10 years.
We'll come back and argue this again. Thank you, Peter.
No problem.
We, of course, been talking with Peter Grandich, who is Chief Market Strategist for Affiliated Financial Management.
Our next guest is so bearish on the market right now, he's recommending a rather risky portfolio mixture, including 10% in cash so as to be poised for shorting stocks. He's also shorting precious metals since he sees a recession by year's end. He also recommends a rather hefty position in bonds, 50% in short and intermediate term bonds. Peter Grandich, our guest, he's Chief Market Strategist for Municipal and Government Securities Corporation of New Jersey and editor of the Grandich letter. He joins us now to elaborate on his investment strategy, which you would admit it's pretty risky, huh?
Well, we wouldn't want to see a little old lady in Arkansas taking that position.
I wouldn't think so. Now, it was 15% cash, part of the portfolio mixture, but you just today bought a couple stocks, huh?
Yes, we did. We purchased Home Shopping Network and Zare Corporation.
Why those two necessarily?
Well, I've been involved in fallen angel stocks, which Home Shopping certainly falls into. I like to find stocks that I believe have been grossly sold down as much as they were grossly run up. Home Shopping falls into that category. Zare, because I really truly think Zare is a true takeover candidate, and in my estimates is in the mid-30s of where it's worth. And the downside risk seems to be somewhere between $15 and $16, so the risk-reward ratio seems worthy to be involved. Plus, the premiums and the options on it have been worthy, and we like to buy it and write covered calls, especially since we're bearish on the stock market.
You were not in this market at all. When did you get out of the stocks?
Well, we sold out in August, went long in January, sold out in May, and have been looking for an opportunity to go short since May 24th, but haven't implemented that strategy.
So you would now want to participate in this uprise that we saw in the stock market from mid-May to about now?
No, I think the philosophy is because I believe over the longer term we're going to have sufficiently lower markets to either play one side, the downside, or don't play at all.
And how long have you been short the precious metals?
We've been short the precious metals since January and increased our short position this past May. We shorted silver about $7.20, platinum around $625, and gold around $468.
That is because you see this recession coming?
Yes, and also the fact that I think if we met anybody a year ago and told them what has occurred, including the crash in the stock market, the fall in the dollar, trouble in the Middle East, they would have wanted to have all the gold they could, and it hasn't moved. And without going into technical jargons, if something didn't go the way it's primed supposedly to go, it's likely to go the other way. And believe it or not, that's our main reason why we've been short.
Now, we're saying in general terms here, precious metals. How exactly did you short them? What did you do?
We shorted as twice as amount in platinum as we would in gold and silver. So we're 50% of our money short in platinum and 25% each in the other two.
In the futures markets?
In the futures market.
Okay, now bonds. How come the short and intermediate terms? Why not the longer?
Well, the yield curve has made it advantageous to stay short term, and even if interest rates do fall dramatically, we still do well. Plus, we had a 10-year note selling around 9%, and the S&P 500 for 60 years has only gone up 9.9%. So since we are our philosophy has been a live chicken than a dead duck, we thought staying short term would be a good way of being safe.
You think interest rates have topped out here?
I don't think the severity of rates and it's being blown out of proportion. I think what's happening in terms of Germany and everybody raising their rates is actually good long term.
Interesting. Thanks for joining us today, Peter.
Sure.
Peter Grandich, our guest, is the Chief Market Strategist with Municipal and Government Securities Corporation of New Jersey and editor of the Grandich Letter.
Peter Grandich, we have an awful lot of people viewing us from Guam to Panama, across the country. A lot of mutual fund holders are saying, boy, Monday morning, I'm out of here.
This is the second time. They might have even made it through in '87 and sat tight, and maybe they've just had enough.
Smart or not.
Enough.
Well, I've been a growling bear since May and June, so I'd have to say I know a lot of people are upset, but I'm one of those few people that are kind of happy at this point in time because I believe some of the things we've been warning about are bearing fruit. I will say this, and we have a very nice guest next to me, and I know Steve for a long time. I don't think no one will know what's going to transpire in the next 48 hours.
Well said, well said.
It takes events. One of the big things that happened in the last crash was some things were said late Sunday at a meeting over in London, which kind of shook the markets up in Tokyo and London, which really helped to lead to that Monday's decline. Today was program trading, no doubt about it.
Period, end of report.
You got it, and
well, this was the week for bears on Wall Street, with the Dow Jones Industrial Average falling approximately 119.5 points. Joining us now is one of those bears. Peter Grandich is the editor of Grandich Publications, and we welcome you to the Market Wrap-Up.
thank you for having me.
You know, it looks pretty good today to be a bear, given the numbers that Neil just gave us and the 119.5 points lost for the week. But if you turn bearish, as your newsletter says, in summer of '89, is that right?
That's correct.
Didn't you miss an awful lot of action?
Well, not really. In fact, we began shorting stocks for the first time ever. All of them were profitable, and then put our clients in bearish option positions just before the crack in October. And right after the crack in October, we looked for one more rally. So we shared in the rally back up through January and then turned bearish again. So you don't try to catch everything. You just try to catch a good part of it, which I think we did.
And you haven't been consistently bearish. You're backing and forth.
No, no doom and gloom or all that all the time. We try to betray both sides.
Now, in the meantime, you are more doomed than anything else. So you've been talking about a pretty big rundown of the Dow. How far?
That's right, Neil. I said at the end of the last year that Dow would go down to about 2,000 without ever going over 3,000 when the market was near 2,800.
All right, by when?
I think by the end of the year we'll get down there 2,200, and then in the early part of 1991. But I hate to make them like they're scripts, but
you're about 1,000 points away from bulls like Stephen Lee.
Well, that's why Steve and I are getting on these shows doing bulls and bears.
That's right, that's right.
There are an awful lot of people, though, who are starting to say, sure, we're going to have to write off the first quarter, maybe even the second quarter, but the bad news is pretty much behind us, and we're going to start seeing the light at the end of the tunnel. Third quarter, beginning of third quarter. You're looking at the same evidence and coming to a different conclusion. Are there two or three things that convince you, compel you to say we're in trouble?
One is, I think Senator Moynihan today, in the last few days, has pointed out that despite all the creative accounting we've had with our budget deficit, we're still really at a very bad point, which shook the markets and more importantly shook foreign investors in '87. So I think that still needs to work. We've been partying a little too long, and we have to pay back, this party we've had.
But that's been true all the time. That's been true for years.
Well, sooner or later it catches up to you, and I think that's what foreigners are concerned about now. They really are getting concerned that we haven't kept our house in order. And with a downturn in the economy, you got to remember during that time we've had a boom in the economy. We don't have that now, and that's what their concern is. The other problem is I think we're going to start to see during 1990 is a potential another oil energy crisis. We're now down to our lowest level in domestic production in 25 years, and we're importing the highest level since 1977. That's why we're seeing oil prices increase, and that's been a great deflator. It's kept inflation a lot lower than really necessary. And I think that's another concern. But these are long terms. This isn't going to all happen next week.
Well, let's talk about short-term concerns. We had GNP and below 1%. A lot of analysts talking about it's going to be ditto that in the first quarter. That would technically negate Graham-Rudman. Are you concerned that the deficit problem goes from bad to worse?
Yeah, that's very important about Graham-Rudman. That I think a lot of investors are going to look and say we haven't been able to live with so-called laws that we passed, and what are they going to do if things get rough? That's what I think the foreign investors are looking at. It's not so much that their interest rates are going up and what have you. They're greatly concerned that our house may not be as in order as we thought it was.
Well, do you buy the argument the Japanese are going to pull out?
No, because they have so much cash, Neil, that they just put it here because it's been stable. They know that it was good politically, a good place to be. After all, if we felt the same way, we should all be over in Britain getting 15% versus 8% in our bond markets. The fact is that the United States is still a very stable country. There's just concerns now there may be some rough edges we have to go through.
We keep hearing the folks who sit on the other side of the aisle from you saying that the indication that we have a cash-rich economy at the moment, that people have pulled out of equities and put their money into, put their investment strategies into cash positions, ready to pounce on the equities market just as soon as we hit bottom, just as soon as the turnaround is evident. You obviously see the same glass half empty.
That's correct. I think one of the problems also is we haven't experienced anything of a downturn. We've had two cracks that people woke up to, didn't even know how to live through it. We haven't had a bear market in 8 years, and unfortunately a lot of people such as myself haven't been in the business long enough to experience a bear market. So a downturn may be artificially accelerated to the downside because of inexperience as well at the people at the helm.
All right, but at 2150 you apparently start buying, don't you?
Well, that's where my model says that stocks overall become a worthwhile buy again.
What do you buy?
Oh, I think stocks that are not going to do as bad in this downturn as technology. They've had their own bear market. I think some of the bank stocks, another 10 or 15% lower, are going to be. It's probably when we're going to know it is the usual question when everybody doesn't want to touch them.
How much lower do the technologies go?
They can go 10%, but I think if the market goes down, and I'm correct, they'll only go down half as much, with some of them maybe even going up during that.
And at this point, you're telling people to what? If they're going to invest in bonds?
Heavily weighted in bonds, 45% to only 20% in common stocks.
All right, well, you certainly staked out a position. We'll talk to you again, Peter. Thank you for joining us.
Thank you for having me.
We've been talking with Peter Grandich, who is editor at Grandich Publications.
We have Ed from Sarasota, Florida. Ed, how are you today?
Fine, thank you.
Good. Your question for Peter.
I've been reading recently about Dome Mining and Campbell Red Lake, Canadian gold mining stocks, being merged with some other large company to be the largest in North America. And I was just wondering if this would be a good time to get Dome Mining.
Well, we had a three-way merger last week, I guess, with Passive Development. Yeah. I have both Dome Mines and Campbell Red Lake. I originally recommended Dome there 9 and Campbell Red Lake around 22, and since they appreciated, I think that's important to note that they will be the largest North American producer if the merger goes through, which you have to wait for approval, something in the order of 850,000 ounces a year. I haven't had a chance to look yet who gets what based on the stocks, but I like Dome Mines very much. I've been a buyer throughout. And if I was going to buy one of them, I'd buy Dome Mines here at around the $15, $16 level.
Yeah, that's come back a bit too. It was up around 17 and change.
So it got up to about 17.5, 18. And another reason why it's moved was its relationship with Dome Petroleum. And it looks like Dome Petroleum has been rescued from, going under. And that alleviates a lot of problems for Dome Mines. And without them, they're a very, very interesting company.
Yeah. Is the rise in, you mentioned Dome Petroleum, does the rise in oil prices at this point support the thesis for metals as well?
Definitely. It's been out of the limelight, but I think the nearby contract made a new high. I think we hit around $19.40. So there's no doubt about it. It's going to lead to the bottom of the consumer prices, and prices are going to go up, and higher oil prices mean higher inflation ahead. Right. So yes, it does add to there.
Okay. Well, it appears that at least for today, the U.S. and Japanese markets recoupled, with Wall Street following Tokyo's lead in today's trading to some degree, and that's a matter of discussion, obviously. Here to discuss the factors influencing the markets is Peter Grandich. He's Chief Market Strategist for AFM Investments. Peter, good to have you with us.
Thank you for having me.
Well, you have your swing at the question, are we recoupled, period? Are we recoupled for the day? Is this nonsense?
Well, my philosophy has been in the last few days, I mentioned to Neil, that people have to realize private investors and professionals act the same way just about all the time worldwide. If their market is suffering, which it is, they won't start off selling off their strong holdings, which at the time was American equities. If the market continues to fall, just like everybody else, you will look for your strong holdings to sell to either match a liquidity crisis, margin calls or what have you, or your positions will come so apparently cheap that you'll try to take profits in places that you have and move in. So the further the Japanese market would fall,
the more likelihood is that they will take profits here simply so they can either meet margin requirements or, in a sense, start buying what they think their stocks are cheaper. So in that sense, I think they're coupled. In other sense, I think they're independent.
Well, now, this obviously falls in favor with your very pessimistic view of the market in the shorter term. The feeling seems to be that if Japan's gone down 22 to 25% this year, that there's all hell to pay for us down the road. Are you of that opinion?
Yes, Neil, as you know, other than in late January turning minorly bullish for the fact of feeling that the market was oversold, we once again reinstated to our clients this past weekend. It was time for another decline because the market is not concentrating on some important factors. Yesterday, a lot of news went by kind of noticing the fact that savings and loan crisis all of a sudden popped up again, to the fact that what's going to happen now with this ruling. It's certainly going to delay some of the process that was going to happen, and it's going to add to the bill. And the bill we're talking about is in the billions. And, you know, billions of dollars can't easily be tossed around in the American economy without paying off somewhere down the line. And that's a problem. You're talking about a credit crunch. People are concerned. The debt is growing larger and larger.
Peter, we saw three major investment houses readjust their portfolios today, Merrill Lynch, Morgan Stanley, Smith Barney, making a position in generalizing. They moved out of equities and into bonds or into cash. But we're still talking about the ideal portfolios maintaining a 40% position about in stock. Sound safe to you?
I'm somewhat lower. I'm no more than 20%, and I've been that way since last August. We've had a market that's really been disguised. If you haven't been in just Dow stocks, and very few people are, there's been segments of the markets that have been hit 30, 40%. And we had a great bull market for 8 years, and the strongest movers were the blue chips. So the likelihood is if we are entering a bear market, which I think we are, the people that are going to put up the biggest fight not to capitulate will be the blue chips, and that's what's happened. In the meantime, the second and third tier stocks are clearly, in my mind, in a bear market. And sooner or later, the blue chips will join, most likely. They very rarely turn it around. And then we'll have, as I've always been saying, an orderly bear market. I don't believe there's crashes around the corner. I just think we're going to have to pull back somewhat and bring ourselves down to a more undervalued area, where I don't think stocks are now.
Are we in a credit crunch right now?
I think perception is the key.
Well, if it's perception, it can be a self-fulfilling prophecy.
Right. And if it begins that way and people start to get concerned, then it could snowball and happen. I don't think we're at that point because one of the things is I think Greenspan has done a fantastic job. And another thing that is
So we don't go into a recession?
I think we're going to a recession, but I don't think it's going to be severe. I think an important part is whether Greenspan is reelected again, and that's what's concerned a lot of powers that be, whether or not Greenspan is going to be reappointed. I think he's done a fantastic job. In fact, he's made most of us call recessions for the last 4 years that haven't happened. He's been that good in what he's done.
Do you think a front-page article in the Wall Street Journal that Neil was making reference to before, saying we're in a credit crunch, there's a big problem, is that an influential thing beyond one day's newspaper reading? In other words, would the Fed take that kind of analysis seriously?
I don't think the Fed will. Investors will, because people tie what's happening in the markets to what's saying in the media. If everybody in the media becomes very, very bearish, again, people become concerned because they feel the media will present the objective views that are occurring in the markets these days. And if everybody's talking bearish, people react, they don't act, they follow, they don't lead. So they'll follow what the theme is at that moment. And so will Wall Street, because Wall Street will react to the mood of what it thinks the investment client will be 6 to 12 months from now.
Well, Peter, if we do have a credit crunch, if we do have banks reticent to lend to businesses and indeed to individuals, would that not even worsen your picture of the market short term?
It would.
How much?
I would say that we could start talking, well, maybe not Procter and PQ wall of 600, but we can talk 13 or 14 or 15. But those are numbers that I don't see now.
What are you talking, 13, 14?
Doubt. And then,
to get that low?
Oh, yes.
When?
You talk about a credit crunch, it can almost happen overnight. See, the one thing that we haven't eliminated, Neil, which is still the haunting and began to haunt the Japanese market this year, is futures trading and index arbitraging. And when those numbers become bearish, those people aren't concerned about the economy. They're only concerned about certain numbers thrive. That's what's happened to Japan. It's been one of the propelling reasons that started the decline. The same thing can happen here. So you can never rule out another 500 or 1,000 point down day, unfortunately, with all the circuit breakers that they claim that are there.
Okay, we're going to have to leave it there, Peter. Thank you for coming in today.
Thank you.
We've been talking with Peter Grandich, Chief Market Strategist for AFM Investments. Kansas City.
Hi, how are you doing?
Fine, thanks.
Over the intermediate term, would it be worth buying a straddle on gold? Do you think it'll be that volatile?
All right, what is he talking about? A straddle on gold?
Well, first of all, I'll tell you about gold. Some people have been concerned that have followed me because I was such a roaring bear up until August of last year and then got out of the market for the most part. Very interesting technically. I think if gold was to get two closes above 520, I think we can see a major breakout to 700. Now, I don't like to hedge. I like to give people outright opinions. However, and I don't like to use the word however often, if the market was to close twice below 452, I think it would be the end of the bull market that we've been occurring since 85 and begin a short-term bear market. And that's important for all the people who are touting that we've still been in a bear market for gold. It's going to be 3 years this February from the lows. Very rare that a long-term bear market had a 3-year rally and then made a new low, which we would have to get under $280.
Now, what is he talking about when he's asking you about a straddle?
Well, there's various strategies you can implement in terms of spreads and straddles where in certain cases you sell one nearby contract and you go along another contract and all. I avoid commodities in general because since the percentages were 80 or 90% of the average investors lose in that, that's not a number that I want to go into. I don't think I'm so special that I'm going to outguess the 9 other people that are standing there with me. However, what I would do if one had to play the gold market now is I'd be looking to write strategies where you feel there isn't going to be a move large one way or another. It's probably the closest thing we've ever had to a Mexican standoff right now in the precious metals market. So I would avoid anything. I would take time on your side, so I'd be a writer versus a buyer of a particular strategy.
All right, there you go. Best of luck to you. And we have Rhea from Seattle, Washington on the line next. Rhea, what's your question?
Yes, I would like to know if government securities fund, a limited partnership type fund, if that would be a secure thing to go into now, or if a utility fund would be better.
All right, thank you. We've talked about government securities already in the show. What about when it comes to a utilities fund? They're often touted as a way to get dividends and earn interest. It's a good idea right now?
Well, I would rather be in a utility fund than a bond fund for one reason is a lot of people were hurt this year that went into bond funds, and the reason they were hurt was not so much that interest rates went up, but the managers within those bond funds were writing certain strategies that went against the market, so their total return dropped to where they actually lost money in a safety or principal investment. Utilities are more of a growth versus a bond fund, so I would rather be in the utility versus the bond fund.
Although they did have a difficult time in '87 too.
Everybody did.
Everybody did, but utilities didn't go up with the rest of the bull market. So it's a difficult time to earn interest these days. Good to have you here. Thank you. Next time you come, we'll get to more of your stocks.
Thank you.
My guest has been Peter Grandich, portfolio strategist with Phillip, Appel & Walden, and editor of the Grandich Letter. Stay tuned for the Wall Street Final coming up at the top of the hour.